Hi, today we're going to talk about fiscal policy in more detail. So, we did discuss in other section in Keynesian economy school of thought. The fiscal policy has a very strong effect on aggregate demand and bringing economy back to the full employment level. Whereas monetarists believe the monetary policy has more effective in bringing the economy to the full employment level and stabilizing prices. So the physical policy can be implemented in two ways. First one is discretionary physical policy, where the government plays a very active role. It intervene in economy by doing the spending or taxing to a certain section of society. We're gonna talk about more. So discretionary, the government actually uh, do the spending and taxation decision. So when economy is in recession, government follows the expansionary fiscal policy by increasing the spending and reducing the taxes so that it can raise the employment level and it can move the output to the full employment level. And we also know when government is spending more and receiving less in terms of in taxes, so that kind of a budget is a called budget deficit. In when the economy is in expansion, or we can say when there's a high inflation, then government can control the inflation by following contractionary fiscal policy by reducing the spending and taxing more. So in this way it can control the inflation. When the government has more tax surplus, and then the spending it's doing is kind of a budget surplus. Most country have a budget deficit because they want to increase their GDP, they want to increase their rate of growth. The second concept is automatic stabilizer. In this, the basic premises is government should not intervene, and there's a automatic stabilizer is built in within the physical economy which kicks in. So at the time of recession, people have low income, tax revenue falls. So due to less taxes and high spending, economy already the budget policy automatically becomes a deficit policy, so government doesn't have to intervene. So during the expansion, when their higher total income, the tax revenue increases and they surpasses the government spending, so the government budget policy automatically follows the surplus policy. Okay, let's go to next section. So there are different objective of physical policy. Um, Basically, they are uh, targeted towards the social welfare, uh, to adjust the aggregate demand level and to redistribute wealth. So we know government do the transfer payment, they provide, they tax the one section of society, and they also provide support to other sections of society in terms of uh, you can say medical benefits or social security benefits or unemployment benefits. So those are kind of transfer payments to redistribute wealth from one section to another section. Resource allocation in separate in various sectors of society. So these are the objective of physical policy, which and they have a the basic premises is social welfare within economy. There are various tools. Government do the spendings by doing the transfer payment, which we just talked about, and the spending in current and capital projects like building dams, building road, building infrastructure, setting up the IT infrastructure or utilities, they all go towards the capital and current spending. Revenue tools, so the way government makes money by taxing companies and individuals. So direct taxes are applied on income and wealth or estate. So it's a slow process. Whereas the indirect taxes are applied on goods and services like sales tax, value added tax. So they are example of indirect taxes. It's very quickly to implement because it just government has to start taxing those goods and services. When it comes to dealing with direct taxes, government is dealing with individuals. Government is dealing with directly those companies. So it's difficult and takes time to it is difficult to implement. There are advantages and disadvantages of fiscal policy. Advantages like a social policy can be implemented quickly via indirect taxes, for example, government can start charging high taxes on tobacco use, so that it wants to discourage the use of tobacco within the country. The quick implementation of indirect taxes also means that the government revenue can be increased without significant additional cost, which we just talked about. Disadvantages: direct tax and transfer payment takes time to implement. We talk about this. The capital spending also takes long time to implement, like building infrastructure projects is not easy, it takes year to complete. Multiplier, so we did in monetary policy, you guys remember we talked about the money multiplier, like the amount of money we inject into the economy and the actual money supply has a money multiplier effect. The same effect which we have it in terms of multiplier when we're talking about the fiscal policy. So the actual effect on our aggregate demand is dependent on this multiplier. So when government do spending, and effect of multiplier will be on much more, it will be at a much higher magnitude, and that's defined by the multiplier. For example, let's suppose government inject like do a spending of, just an example, like $100. So that $100 will go into somebody's pocket, like government made a payment to its contractor, so the contractor earns that $100. Out of those $100, it still have to pay taxes, so the tax effect brings down the multiplier. However, if that $100, if contractor spends further or in consumption or investment, so it will also again have a multiplier effect, because that $100 after deducting the tax, let's say $70 will go to somebody else pocket who again do consumption or investment. So because of this multiplier effect, the actual increase in aggregate demand is much more than what the government actually spent. So the physical multiplier is directly depend on the marginal propensity of consumption, which we have discussed in the past, and it is negatively related with the tax rate. And if you read this section further in detail, there is a concept of balanced physical multiplier. So and the balanced physical multiplier, what it says, there's a physical multiplier which gets affected by increasing the spending. Our aggregate demands increases much more due to this physical multiplier. So by increasing the tax rate, the aggregate demands goes down, because we are charging more tax to consumer, and the consumers will consume less or will invest less. So the balance multiplier is to come up with the amount of taxing and amount of spending, so that the budget goes into the balance mode, it doesn't go into deficit or surplus mode. That's it. Thank you.